Everybody wants to buy a house, but why are the prices always rising? Join billionaire investor Jeremy Grantham's insight into this financial game changer. Are you ready for the real estate storm? Guess what? Grantham is like the Sherlock Holmes of finance. He successfully predicted the tech bubble of the early 2000s and saw the storm coming before the 2007 to 2008 financial crisis hit. Now he's waving his arms and shouting from the rooftops about a new bubble, and this time it's in real estate. Picture this. You have dreams of owning your own place, but here's the problem: houses have become so ridiculously expensive that it feels like you need to win the lottery just to afford a decent home. Grantham points to a simple metric to explain why this housing madness is unsustainable. It's like a magic formula that compares the average income of a regular family to the cost of the average house. Let's call this family Jack and Jill. If Jack and Jill's combined income is $60,000 a year and the average house in their city costs $240,000, that's a ratio of 4-to-1. In simpler terms, a house is 4 times the average family income. Now fast forward a bit. Jack and Jill get a raise, and their income jumps to $70,000. Hooray for them. But oh no, the average house price skyrockets to $422,000. Now, the ratio is 6-to-1. The house is now 6 times the average family income. This is where it gets dicey because, just like with stocks, when this ratio gets too high, it means the housing market might be overvalued. Grantham believes we're in the danger zone. He says the housing bubble is not just a local problem, it's global. Houses are crazily expensive everywhere, from China to Canada to the UK. Think about it. In places like China, the ratio is a jaw-dropping 15 to 20 times the average family income. That's like trying to buy a house with monopoly money. Imagine trying to buy a house when it costs 20 times your family's income. Not happening. He says the problem is getting worse because mortgage rates have jumped from 3 to 7. That means it's tougher for people to afford homes. And guess what? Youngsters just starting out can forget about buying a house. It's impossible. So, what does this mean for the future? Grantham predicts a real estate roller coaster, and it's not going up. Eventually, the house prices will come down, he says. It's not a matter of if, but when. And when they do, it might feel like World War III for some, especially in places like Australia where people are more optimistic than Americans but might have to face a harsh reality. Houses might get 30% cheaper. It's like waiting for a slow-motion crash, but Grantham insists it's better to brace ourselves for impact now than pretend everything will be just fine. So, for all those dreaming of a home of their own, it might be wise to keep an eye on that income-to-house price ratio and hope the bubble doesn't burst too dramatically. Buying a house for the first time is an exciting prospect, a milestone that many aspire to achieve. However, for first-time homebuyers, the journey is often fraught with challenges, especially when it comes to financing their dream home. Unlike seasoned homeowners who can leverage the equity from selling their existing property, first-time buyers find themselves relying solely on their income, making the process all the more daunting. So what's left? Income. And guess what? It's becoming a real challenge. One critical factor influencing the affordability of homes for first-time buyers is the home price to income ratio. This ratio essentially measures how much a typical family needs to stretch their finances to buy a home. The higher the ratio, the more financial strain on prospective buyers. In the United States, recent data reveals a staggering ratio of nearly 7.5, indicating that home prices have reached unprecedented levels compared to median household incomes. To grasp the significance of this, let's take a historical journey. In the aftermath of World War II, the home price to income ratio rose above 6, but a construction boom in the U.S. led to an influx of affordable starter homes. As women entered the workforce in the following decades, household incomes rose, helping offset the increase in home prices. However, since the year 2000, Wage growth has failed to keep pace with rising home prices, creating a growing gap between what families can afford and the cost of homes. In a CNN exclusive, Grantham stated, "Other things will break, and who knows what they will be. The financial system is still under a great deal of stress." Bearish views are well known for the co-founder of the investment firm GMO. Grantham referred to the coronavirus pandemic-induced frenzy in several U.S. markets as one of the great bubbles of financial history in 2021, citing the historically low interest rates at the time. U.S. stocks have decreased by roughly 15% since the S&P 500 reached its highest point in early 2022 due to higher borrowing costs imposed by central banks. However, Grantham anticipates much sharper declines. "The best we can hope for," he said, "is a fall of about 27% from current levels, while the worst-case scenario would see a plunge of more than 50%. The low point might not arrive until deep into next year," he added. The P/E ratio for a stock, which denotes possible overvaluation, is comparable to the metric used to compare annual income to average home price. According to Grantham, there is a 70% likelihood that the U.S. will have a recession in the upcoming years. Real estate and the U.S. should be avoided by investors, as Grantham advises investors to stay away from the U.S. and real estate, because he thinks these investments are overpriced and may suffer in a downturn. Presently, the Grantham Foundation invests 75% of its capital in green venture capital. The remaining funds are allocated to liquid assets that are short the market. "I would focus on stocks that are not US-based. Like most people, if I had to purchase US stocks, I would focus on quality," said the man. He contended that quality shields investors from the deteriorating economic outlook to a considerable degree. Premium stocks ought to yield a point less, in line with triple a bond's yield, but they don't. In actuality, quality stocks have yielded an extra half a point over the past 150 or 10 years, he said. The issue isn't unique to the United States. It's a global concern. In the UK, the home price to income ratio recently peaked at over 9, while in Australia, the ratio exceeds 10.5. Sydney, one of Australia's largest cities, boasts a jaw-dropping ratio of 16.8, making homeownership seem like an unattainable dream for many. Meanwhile, Canada faces its own affordability crisis, with a national ratio over 10 in major cities like Victoria, Vancouver, and Toronto reporting even higher figures. Real estate bubbles are not a new phenomenon. Japan experienced a surge in home prices in the late 1980s, with a home price to income ratio reaching 7.4 in 1989. However, what makes the current situation unique is that it appears to be a truly global real estate bubble, affecting countries and cities around the world simultaneously. Adding to the challenges faced by first-time homebuyers is the recent surge in interest rates. In the United States, 78% of homebuyers used a loan to finance their purchase in 2022, emphasizing the dependency on favorable interest rates for housing affordability. The average interest rate on a 30-year fixed-rate mortgage climbed from 2.65% in January 2021 to nearly 8%, significantly impacting monthly mortgage payments. But why aren't home prices going down with these higher rates? Unlike the stock market, the real estate market is slow-moving and less liquid. Real estate transactions take weeks or months, involving various professionals and incurring substantial costs. This lack of immediacy in adjusting to economic changes exacerbates the challenges faced by both buyers and sellers. The current mismatch between seller expectations and buyer affordability has led to a significant decline in real estate transactions, approaching a two-decade low. However, the slow adjustment process doesn't mean a correction won't happen. In a hypothetical scenario, a homeowner who can't afford 2 mortgage payments may eventually become a forced seller, lowering the listing price and contributing to a market correction. So when will the bubble burst? That's the million-dollar question. Unlike the stock market, real estate moves at a snail's pace. It took almost 5 years for U.S. home prices to fully drop after the 2007 peak. While it remains uncertain when the bubble will burst, one thing is clear: either home prices or interest rates need to come down for global home affordability to return to more sustainable levels. If not, we may be heading into an era where homeownership becomes an elusive goal for many worldwide. As we navigate these challenging times, prospective buyers and industry experts alike are closely watching for signs of change in the real estate landscape. Do share your opinions in the comments section below, and don't forget to like, share, and subscribe for more similar content. We'll see you next time. Until then, bye.